Hello everyone, welcome to the class of Introduction to Finance. Today let's continue with Chapter 7. This is our third class of Chapter 7. So in the previous two classes we discussed the key features of bonds and bond valuation as well as yield to maturity. So let's actually quickly go through what we discussed before. So under key characteristics of bonds we discussed what is par value, which is the same as face value, and in most of the cases that we discussed, the face value is always $1,000. And then we discussed coupon interest rate. So this is very important for us to determine how to calculate payment, right? Payment is one of the 5 key variables in the calculations with time value of money, financial calculation, right? So we use par value times coupon interest rate, and then we will be able to get the annual payment. And then maturity date, which usually determines the number of period. And then call prevention. So this is also important. That differentiates between the two yields. Yield to maturity, we discussed this one last week, and then yield to call. So this is what we are going to discuss today. And then also sinking fund. This one, there's no calculation involved with sinking fund. You just need to know what it means, especially what it means for the required rate of return. Yeah, is it beneficial to the investors or to the issuing company? And then other features including warrant, etc. or put option and etc. So that's key characteristics of bonds. Then bond valuation, so that's basically just an application of time value of money on the bond. And then we also discussed yield to maturity. Yeah, so this is just the calculation for the rate of return based on all the information that you could have for a bond, including the purchase price, the face value, the number of years to maturity, the coupon interest rate, and the market interest rate. Right, market interest rate is usually the yield to maturity. Well, depending on depending on the when you buy the bond. Yeah, so if you usually the yield to maturity will be equal to the market interest rate if the purchase price equal to the fair price of the bond, like the purchase price equals to the current market price. But if it differs, then the yield to maturity will also differ from the market interest rate. And then today we're going to discuss yield to call. Yeah, so and apart from that, we will also discuss some changes in bond values over time, and also the 2 types of bond riskiness, including price risk and reinvestment risk. So that's what we're going to discuss today. Yeah, and it's actually related to the 3rd and the 4th learning goal, that you should be able to calculate the bonds yield to maturity. That's what we discussed before, and yield to call. That's what we're going to discuss today, if it is callable, and determine the true yield, and explain the different types of risk that bond investors and issuers face, and discuss how a bond's term and collateral can be changed to affect its interest rate. So this is what we discussed before. Let's go to yield to maturity. Just quickly go through yield to maturity. So what is yield to maturity? That's the rate of interest you earn on your investment if you bought a bond, held it to maturity, and received the promised interest payments and maturity value, right? So it's based on your purchase price, that is the PV, and then also based on your future interests, future cash flows, including the promised interest payments and the face value, and also the number of years to maturity. And then the interest rate that solves this model will be the yield to maturity. Yeah. So basically, for example, if the purchase price is exactly the current price, then your yield to maturity is exactly the same as the current market interest rate. And so this is like how to calculate the yield to maturity. I give you the purchase price of the bond, and then you know the coupon interest rate that you can use to calculate the payment. You know the face value, you know the number of years left to maturity, then you can calculate the interest rate, that is the yield to maturity. Okay, now let's discuss what is yield to call. So yield to call is only for a specific type of bond, that is a callable bond. Yield to maturity can be applied to any type of bond. Yeah, so as long as it's a bond, you can calculate its yield to maturity, but it's only for callable bond that you can calculate its yield to call. So a callable bond is likely to be called if current interest rates are well below an outstanding bond's coupon rate. An investor will estimate its most likely rate of return as the yield to call rather than yield to maturity. Yeah, so that's the meaning of yield to maturity. So, and it follows this equation. So the price of the bond, which is the present value of the bond, will be equal to the discounting value of all the future cash flows, including the interest payments every period, plus the discounting value of the call price. Yeah, where n is the number of years to call, and the ending payment is the call price rather than the maturity value. Yeah, so that's the key difference here. We no longer use the par value or the face value. Here we use call price, and then because the time to call or the date, the number of years to call is different from the number of years to the maturity, so n will be different too. So that means when you calculate yield to call, there are two key variables that are going to be different. One is the future value. So for yield to maturity, the face value is the future value, but for yield to call, the future value is not going to be the face value anymore. It's going to be the call price. And then the other variable that is going to be different is n. So for yield to maturity, you'll need to use the number of years to maturity, but for yield to call, you're going to use the number of years to call. So that's the key difference here. Here's an exercise question that will help you better understand the meaning of yield to call. It says you have just purchased an outstanding 15-year bond with a par value of $1,000 for $1,145.68. Its annual coupon payment is $75. We calculated the yield to maturity of this bond is 6%. Now assume that this bond is callable in 7 years at a price of $1,075. What is the bond's yield to call? Yeah, so if the yield curve remains flat at its current level during this time period, would you expect to earn the yield to maturity or the yield to call? So there are two questions in this exercise. First is to calculate what is the yield to call. Second is to tell whether the investor is going to earn the yield to maturity and yield to call. So let's look at the first question together. This one is to calculate yield to call. Remember, yield to call is very similar. The calculation process is very similar to that of yield to maturity. The only two variables that are different is the n. We have to change it from number of years to maturity to number of years to call. And also the other thing that is different is the future value. We'll change it from the future value to the call price. So let's have a look at this question together. Outstanding 15-year bond, which means 15 is the n, the number of years to maturity. $1,000 is the par value, right? And $1,145.68 is the price. So this is the PV. This $1,145.68, this is the PV. $75 is the payment. Yeah, and then the yield to maturity is 6%. Yeah, that means if you use 1,000 as the future value, 15 as the N, and 75 as the payment, and then this 1,145.68 cents is the present value. You'll get the I/Y, the required rate of return at 6%. But now we're calculating yield to call, so we have to change N from 15 to 7, right? Because the bond is callable in 7 years. And also change the future value from $1,000 to $1,075. This is going to be the future value, right? Because this is how much the company will pay the investor if the company decides to call back the bond. Yeah, so, but the others all remain the same. The present value is $1,145.68. The payment is $75. So all the other two are the same. You only need to change N and future value. And then this time the interest rate you calculated is going to be yield to call. So let's see. 75 is the same. Purchase price is the same. Don't forget to add a negative sign here. But the future value now has become call price. It's no longer the par value. And the N has become the number of years to call, no longer the number of years to maturity. Then the interest rate you calculated is 5.81. That's the yield to call, not the 6% yield to maturity. And you could tell that this bond is selling at a premium, which means the interest rates have declined since the bond was originally issued. Why is that? Because the coupon interest rate is higher than the current market interest rate. Yeah, so and the coupon interest rate is 7.5%, right? So that means the current market interest rate, or those two yields are definitely going to be lower than 7.5%. Okay, now we have answered the first part of this question, that is to calculate the bond's yield to call. Then the second part of the question asks if the yield curve remains flat at its current level during this time period, would you expect to earn the yield to maturity or the yield to call? How to answer this question? We have to first understand it, right? So it says if the yield curve remains flat at its current level during this time period, what does it mean? It means that if the market interest rate remains the same, remains flat for at least a period of time, yeah, then let's say at least until maturity. So during this time period, then in this case, would you expect to earn the yield to maturity or yield to call? Basically, this question is the same as asking, let's assume the market interest rate doesn't change for the next 15 years. Do you think the company is going to call back the bond or not? If the company is going to call back the bond, then the investor will expect to earn the yield to call, right? If the company doesn't call back the bond, then the investor will expect to earn the yield to maturity, right? Because call prevention is the right of the issuing firm, right? So as long as the firm wants to call back the bond, the investor has to sell the bond back to the firm, to the issuing firm. So the question seems as if it's asking about the investor, whether the investor will earn the yield to maturity or yield to call. But it is actually asking whether the company is going to call back the bond or not. Okay, so now let's put ourselves in the company's shoes and try to think, if I am the issuing company, would I try to call back the bond or not? Then I'm basically comparing two options for myself if I am the issuing company, right? So if I don't call back the bond, then I leave the bond to mature in 15 years, and my cost is going to be $75 every year, right? So this is the coupon interest rate I have to pay. This is what I promised to pay the investors when I issue the bond. But if I decide to call back the bond at this price, then then I can basically issue the new bond at a lower coupon interest rate, right? Which is 6%. That's the market interest rate. Yeah. So that's basically comparing. It's $75 is I'm basically comparing these two interest rates, the coupon interest rate and the yield to maturity, the market interest rate. If the market interest rate is higher than the coupon interest rate, then in this case, I prefer not to call back, because if I call back, I have to issue new bond, because I still need money for my project, right, for my investment. So if I call back this bond, I have to issue new bond at a higher interest rate, which is the market interest rate. So if the market interest rate is higher than the coupon interest rate, then I'm definitely not going to call back the bond. But if the market interest rate is lower than the coupon interest rate, then it is going to be beneficial for me to call back the bond. Yeah. Here we kind of just ignore the little difference between the call price and the face value. So when you see such questions, you basically are comparing two things: the yield to maturity, which represents the market interest rate, and the coupon interest rate. If the coupon interest rate is higher, then in this case it's beneficial for the company to call back the bond and issue new bond at a lower interest rate, which is the market interest rate, the same as the yield to maturity. But if the coupon interest rate is lower than the yield to maturity, then in this case the company is not going to call back the bond, and the investor is going to earn the yield to maturity, not yield to call. Yeah, and then let's come back to this example. So we know that the coupon interest rate is 7.5%. Yeah, that's 75 divided by 1,000, so it's 7.5%. And the yield to maturity is 6%. So which one's higher? Definitely the coupon interest rate, right? So that means if the company decides to call back the bond and issue new bond at 6%, then it's going to be beneficial for the company, right? So therefore, in this case, the company is going to call back the bond and issue new bond at a lower market interest rate. In other words, the investor is going to expect to earn the yield to call. If the yield curve remains flat at its current level, means that the market interest rate doesn't change for the next, let's say, 15 years. Yeah. So that's basically the answer for the second part of the question. If the yield curve remained flat at this current level during the next 7 years, you would expect the firm to call the bond and issue bonds at the lower 6% interest rate, assuming the cost of doing so was lower than the 75 minus $60 equal to $15 savings per bond. Yeah, so this is basically trying to considering the price difference and the cost of issuing new bond and everything. But let's just have this as the assumption. We only compare the coupon interest rate, which is 7.75 or 7.5%, with the market interest rate, which is 6%, the same as yield to maturity, to decide whether the investor is going to earn yield to maturity or yield to call. Yeah. So that's this exercise question, and it's very important. I'm guaranteeing you that you are going to see similar questions like this in the quiz. Yeah. Okay, so now let's discuss the second learning goal for today. That is comparing the two risks. The first is the price risk. What is price risk? That's the first question. And the second question we want to know is, does maturity matter for price risk? So which means if you compare a 1-year or a 10-year bond that has everything else the same, which one has more price risk? Yeah, so first let's look at what is price risk. Price risk is the concern that a rising interest rate, this is RD, so discounting interest rate, which is the market interest rate. So a rising interest rate will cause the value of bond to fall. That's price risk. Yeah, so that means the price risk is basically the risk of the price of the bond falling, right? So That's the price risk. When you, as an investor, when you buy something, no matter what type of asset, no matter whether it's stock or bond or houses, after you buy such asset, you want the price to keep rising, right? So that you will not only have, let's say, a dividend or interest income from this investment, but also you're going to have capital gains. So price risk is the risk that after you buy this asset, the market conditions has changed, and also the interest rate has changed, that will lead to the change, especially the decline in the price of the asset you invested in. Yeah. So why would a rising interest rate would cause the value of the bond to fall? That's the about the bond valuation that we discussed before, right? So if the market interest rate is rising, and market interest rate is the interest rate that we use to discount all the future cash flows, right? So if the current market interest rate keeps rising, which means the future cash flow will be discounted much more, right? Because we use the current market interest rate as the discounted interest rate, which, if you remember the equation of the bond valuation, you'll know that discounted interest rate is in the bottom, in the denominator, right? So the higher the denominator, the lower the price of the bond, right? So therefore, a rising interest rate would cause the value of the bond to fall. But that's basically the definition of price risk. But not only we want to know what is price risk, we also want to know what are the factors that matter for the price risk. So first, let's look at the maturity. Here we are comparing two types of securities, a 1-year bond and a 10-year bond. And this is the market interest rate, assuming everything else is the same. Yeah, so assume that based on the price, so this is the price. Based on the price, can you tell that what is the coupon interest rate here? You can actually see it's very straightforward. The coupon interest rate is 10%, because when the market interest rate is 10%, the price is exactly the same as the face value. That means the coupon interest rate is the same as the market interest rate. So this 1-year bond pays 10% coupon interest rate, and this 10-year bond also pays 10% coupon interest rate. And therefore, you will know the maturity, n equal to 1 for this bond, right? N equal to 10 for this bond. You know the payment is $100 for both bonds, because the coupon interest rate is the same. You know the future value, which is $1,000. You know the market interest rate, which is this 5, right? 5%, 10%, these three values, 5%, 10%, or 15%. Therefore, you can calculate the present value, which is the price of the bond. So that's what we learned in the previous class about bond valuation. Therefore, we can calculate. So this column shows you the price of the bond. This column is the market interest rate, the discounting interest rate. And you can see when the market interest rate is 5% and the coupon interest rate is 10%, the bond is selling at a premium, right? Because the coupon interest rate is higher than the market interest rate. But if the coupon interest rate is 10% and the market interest rate is 15%, the bonds are selling at discount. Yeah, makes sense, right? And when these two are the same, when the coupon interest rate is the same as the market interest rate, the price is the same as the face value. Yeah, so that's the first step. We want to calculate the price change. How does the price change accordingly to the change in the market interest rate? Second, we not only want to see the price, we also want to calculate the percentage of the change in the price, so the change, and we can calculate. So let's say if the market interest rate falls from 10% to 5%, the price increase by $47. So this is the change in the price. And then if the market interest rate increase from 10% to 15%, the price falls, right? So this is the percentage change. The base price is always $1,000. And for this 10-year bond, we can also calculate if the market interest rate declines from 10% to 5%, the price increases by almost increase more than 38%. But if the market interest rate increases from 10% to 5%, the price declines by more than 25%. Yeah, so if you compare these two bonds, everything else is the same company, the same coupon interest rate. The only thing that differs is the maturity. So you see clearly this 10-year bond has experienced much bigger price change compared to the 1-year bond, right? What does it mean? It means that the price of this 10-year bond is much more sensitive compared to this 1-year bond. Yeah, so it says the 10-year bond is more sensitive to interest rate changes and hence has more price risk. So that's the first thing. That's the second thing I want you to know, is that maturity matters for price risk. The longer the maturity, the higher the price risk. Yeah, it makes sense, right? Because for those bonds with longer maturities, you are going to discount much more cash flows in the future, right? Therefore, the price change is going to be bigger because you have much more cash flow to discount. And if you draw a curve based on the price we calculated, then you can basically draw a curve like this. So this 1-year bond, the vertical line is the price of the bond, the value. The horizontal line is the market interest rate, yield to maturity. So you see that as the market interest rate increase from 5% to 10% to 15%, the price is declining, but not much, based on these three numbers, right? The highest is $1,047 to $1,000 to $956. So these three numbers here. But for the 10-year bond, the variation is much bigger, from almost $1,400 to $1,000 to $749. So this is the other curve. So you can clearly see for the 10-year bond, the slope is much bigger than the 1-year bond, right? Which means for the same change in the interest rate, the price change for the 10-year bond is much bigger compared to the 1-year bond. Yeah, and then so that was maturity, and now let's look at the other part, that is the coupon rate. So here it's asking what is the coupon rate in this example. We could already tell, right, that coupon interest rate is 10%, because when the market interest rate is 10%, the face value equals to the price. So therefore, the coupon interest rate is 10%. But what if the coupon interest rate is 5%? Okay, so now let's try to compare two bonds with the same maturity and everything else is the same except for the coupon interest rate. So here you see we are trying to compare this we're trying to compare these two type of bond, but compare it with the other one. So here it says that if the coupon interest rate is 5%, so you see these two bonds. Now the price equals to $1,000 when the market interest rate is 5%, right? So we have changed both. For both bonds, the coupon interest rate now is 5%. Therefore, we can calculate the price of the bond like this, because if the market interest rate is 10% or 15%, yet the coupon interest rate is only 5%, then definitely these bonds are going to be selling at discount. So this is going to be their price, right? And then this is going to be the price change, right? So from 10% to $1,000, and then from 10% to 5%, and from 10% to 15%. So this is the price change. And you could tell that clearly if we compare this one with the one in the other slide, because here we're trying to compare the same maturity but different coupon interest rate. So let's first use the 10 years as an example, we see that the price change is that from 10% to 5%, it's increasing 44%. From 10%, when the market interest rate increased from 10% to 15%, the price declined by 28%. But remember the one here we see. So for the same interest rate change, if the coupon interest rate is 10%, the price change is 38%, right? And decline by 25%. But here it's 44% and 28%. So clearly, if we compare these two types of bonds with everything else is the same except for the coupon interest rate, then the one with higher coupon interest rate seem to experience lower price change, right? It's the same for this for this 1-year bond, but the difference is not as big as this 10-year bond. So what does it mean? It means that higher coupon rates could help reduce the price risk. Yeah. So it means that the one with the higher coupon, so the other one, the 10% coupon, experience much smaller price change. So that means they could have lower price risk. So now we have looked at two factors that could affect the price risk. So for bonds with longer maturities, the long maturity would increase the price risk, and higher coupon rates would reduce the price risk. So the maturity and the coupon seem to have the opposite effect on the price risk. And this is important. You kind of have to know this. I didn't highlight it because in the slides in the next few pages there's a summary, and that part is important, so I didn't highlight it here. But here is trying to break down the whole process of showing you how to compare the price and how to calculate the price change, and to show you how could the coupon interest rate and the maturity affect the price risk. So compared to the 10% coupon interest rate, the 5% coupon rate bond is more sensitive to interest rate changes and hence has more price risk. Yeah. So now we have discussed like price risk, and we discussed what is price risk and how could maturity and coupon interest rate affect the price risk, right? The next part is the reinvestment risk, but we'll leave this to our last class of chapter 7. So we'll end our class here for today. Thank you all for attending. I'll see you next time.